Although Facebook's parent company, Meta Platforms, is investing heavily in virtual reality, its actual implementation is currently looking like a complete mess. Actually, more like a train wreck. Following the release of an earnings report that a Wall Street analyst referred to as a train wreck, Meta shares fell 24% to their lowest point in over 4 years earlier on Thursday. And, well, it looks as if Meta doesn't really know where it's headed. However, we, on the other hand, know what's happening inside out. And so, we'd like to give you a scoop full of details as well. So, without further ado, watch today's video to the end, as we reveal shocking details. Let's begin. Facebook was still on a high in the fall of last year. As of September 2021, its market value peaked at more than $1 trillion. As advertisers raced to Facebook and Instagram to reach their billions of users, revenue and profits soared. Unfortunately, after an earnings report that one Wall Street analyst called a train wreck, Meta shares fell 24% earlier this Thursday, reaching their lowest point in almost 4 years. It's a long cry from the situation the business found itself in on October 28, 2021, when CEO Mark Zuckerberg made the fanfare-filled announcement that Facebook was changing its name to Meta Platforms to underscore its focus on the metaverse. Yes, the tech sector as a whole has suffered this year, but Meta's stock decline has far exceeded the industry as a whole, with its shares down 67% from a year ago compared to the tech-heavy Nasdaq's 31% decline over the same time frame. Additionally, the shocking market value loss caused by Meta's fall amounts to around $700 billion. As of this past Thursday, the market value of Meta decreased to $268 billion, from above $1 trillion in September 2021. On the other hand, on Friday morning, the shares made modest progress again, increasing by $1.72, or around 1.8%, to $99.66 per share. The company's struggles raise concerns about its all-in wager on the metaverse and whether the social media giant will follow in the footsteps of other significant corporations whose bets on the future have failed. Consequently, as the economy weakens and advertisers cut spending, Meta's core Facebook business will likely face difficulties in the foreseeable future. Thus, as Wedbush analyst Dan Ives put it, and we quote, "Meta's results last night was an absolute train wreck that speaks to pervasive digital advertising doldrums ahead for Zuckerberg and co. as they make the risky and head-scratching bet on the metaverse." Due to his 13% ownership share in the social media firm, which accounts for the majority of his income, the blow to Meta has also reduced Zuckerberg's worth. According to the Bloomberg Billionaires Index, as of October 27th, he had a $37.7 billion net worth, but had lost about $88 billion in wealth over the previous 12 months. So now, let's look at the 3 main problems that are hurting Meta shares and raising more concerns about its long-term prospects. Let's first start with the $9.4 billion in metaverse losses. Yes, you heard that right. In a conference call with investors to discuss Meta's most recent profits, Zuckerberg said he is very sure this is going in a favorable direction, but the investors are unpersuaded. And honestly, they're not to blame either. That's because the business is essentially betting the farm on its capacity to develop into a virtual reality juggernaut, and whether that technology can drive the subsequent stage of Meta's growth. And it's quite evident that the early results for Meta have been dismal, even accounting for the fact that large corporations often take years to implement such strategic pivots, as it did for IBM and Microsoft as they switched from selling hardware to software. Hence, as a result, Meta's metaverse division, Reality Labs, lost $9.4 billion in the first 9 months of the year, whereas the company has predicted that the segment will see substantially larger operating losses in 2023. Because consumers haven't exactly flocked to the nascent metaverse, at least thus far, investors are dubious. Contrary to the lengthy timelines for business development that are typical in Silicon Valley, it's a fact that Wall Street evaluates companies based on immediate results rather than hazy estimates that extend years into the future. According to a Wall Street Journal report from earlier this month, Horizon Worlds, Meta's new virtual world, has lowered its target for monthly active users from 500,000 to 280,000, but is still drawing less than 200,000 users. That being said, let's move on to our second key issue that's hurting the Meta shares, which basically concerns slower Facebook growth. Comparatively, Facebook had a sizable base of 1.98 billion active daily users on average for September, an increase of 3% from the same month last year. Although that might sound commendable, Facebook hasn't enjoyed the massive growth it did in prior years. The slower growth also follows Facebook's announcement in February that it had lost users for the first time. The social media behemoth, which is a major source of income for Meta, is under competition from upstarts like TikTok, which is, of course, attracting younger users. And finally, advertising challenges. That's right, the advertising income generated by Facebook, Instagram, and WhatsApp, with companies eager to reach their billions of daily users, is the lifeblood of Meta. However, its most recent quarter's ad revenue dropped, while sales dropped 3.7%, raising investor concerns further. Thus, Meta is dealing with two setbacks on the advertising front. First, with the corporation, citing an uncertain and turbulent socioeconomic landscape for ads on Wednesday, a slowing economy means that advertisers are curtailing expenditure. And second, the corporation is also considering how Apple's privacy reforms would affect the apps that run on its devices. So, customers can now instruct applications to stop tracking them, a shift that Facebook has estimated will cost it $10 billion this year. So, what does Zuckerberg have to say about it all? Zuckerberg appears to be shocked by everything that's currently happening in the metaverse, and has remarked, "There are a lot of things going on right now in the business and the globe, so it's impossible to have it straightforward. We're going to do one thing, and that's going to solve all the concerns." Well, you better come up with that one thing quick, Mr. Zuckerberg, because right now, Apple and all your other competitors seem quite hungry. Additionally, according to Zuckerberg, Meta is struggling with several issues, including the weak economy, the lingering impacts of Apple's 2021 iOS privacy update that made it more difficult for Meta to target adverts to consumers, and competition from rivals like TikTok. He predicted that the long-term investments in the metaverse will provide bigger returns over time. And we sure hope so as well. Fingers are crossed on this one. Further, Zuckerberg has admitted that one of the reasons his business is creating the metaverse is to guarantee that its platform won't be negatively influenced by decisions made by competitors like Apple in the future. Zuckerberg has stated that the main rationale for creating the metaverse is that technology businesses may be more creative when they provide both the software and hardware that support a computing platform. Well, it seems like he has a lot of theories going on, but not a concrete plan in action, and the latter seems to be more in demand at the moment. Before we head toward the end of the video, there's something that you should know quickly. While all of this is going on for Zuckerberg and his very own Meta, in an open letter to the firm and its CEO Mark Zuckerberg on Monday, Altimeter Capital Chair and CEO Brad Gerstner stated that Meta has too many workers and is progressing too slowly to maintain the trust of investors. Really? Did he really need to do this right now? Consequently, the Meta investor suggested a strategy to restore the business's mojo, which included cutting headcount costs by 20% and capping the company's expensive investments in metaverse technology, or VR software and hardware, at $5 billion annually. Therefore, the letter is the most recent indication that Meta shareholders are beginning to voice concerns with the business's recent performance. In 2022, Meta stock is down more than 61%. Altimeter Capital owned more than 2 million shares in Meta at the end of the second quarter of this year. Additionally, it expresses a lack of faith in the company's plans to enter the virtual and augmented reality industries. To better concentrate on its VR hardware and software, Meta changed the name of its business from Facebook and is investing $10 billion annually in the technology. Well, that's it for today. We hope that Meta survives this one through to the end. Feel free to share your thoughts on this with us in the comments below. If you wish to hear from us again, do give us a like and subscribe, and we'll see you again in no time.